This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
Time to cut back. Fed Chairman Bernanke hints at when the central bank may start reeling in all that stimulus, and it could be sooner than many think.
Investors hung on his every word, and it resulted in big market swings. So big, in fact, that the last time the Dow was up more than 150 points but closed down for the day was in March of 2009.
And a game changer in healthcare. In part 2 of our series, we'll look at how real-time data is helping patients stay healthy and out of the hospital. We have all that and more tonight on Nightly Business Report for Wednesday, May 22nd.
Good evening, everyone. Our top story tonight, the Fed, the future, and your money. Federal Reserve Chief Ben Bernanke testified on Capitol Hill today, and investors spent the entire day trying to figure out exactly what his statements mean for the future of interest rates, the central bank's bond purchase program, and stock and bond prices. Couple Bernanke's testimony with the release of the minutes from the Fed's last policy-setting meeting, and you have the recipe for a wild day on Wall Street. And that is precisely what happened. The Dow and the S&P 500 zoomed to record highs in the morning. At one point, the Dow was up 150. Then, after the release of those Fed minutes at 2 p.m., it hit session lows off more than 100 points on speculation the Fed could cut back on its bond buying as soon as next month. At the end of the day, the Dow lost 80 in its biggest point reversal from high to close since 2008. The S&P 500 fell 14 and the Nasdaq dipped nearly 39. Two reports tonight looking at Bernanke's testimony and the markets. We begin with Steve Leisman.
It was a day of confusing comments from the nation's central bank, and investors ultimately concluded the Fed will be providing less help for the economy than it previously thought. The day began with commentary from Federal Reserve Chairman Ben Bernanke. The market rallied when he suggested the Fed would not change policy.
The best way to achieve higher returns in the medium term and beyond is for the Federal Reserve, consistent with its congressional mandate, to provide policy accommodation as needed to foster maximum employment and price stability.
But later in his congressional testimony, Bernanke responded to a question by saying, well, on second thought, the Fed could change policy pretty soon.
If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases.
If that wasn't enough, later in the day, the Fed released the minutes of its May meeting, saying a lot of its rate-setting committee members believe the Fed should reduce the amount of bonds being bought as soon as June, even though there is no agreement on whether that should happen. Ultimately, the consensus seemed to be that the Fed is going to take its foot off the accelerator of the economy sooner than markets believed, as long as enough jobs are being produced. For more on how the market reacted, here's Bob Pisani.
There's an old floor saying that goes, don't play on days when the Fed speaks. That was certainly true today as traders were treated to a head-spinning session, with traders chasing both sides of the Fed debate. Stocks were up 150 points shortly after Bernanke began his testimony, as he said that any change in the flow of bond purchases will depend on the incoming data, and that ending stimulus too soon would be a mistake. But stocks came off their highs as the testimony switched to the Q&A. Bernanke said the Fed might considering tapering bond purchases in the next few meetings if the data supports an improving jobs picture. That was echoed midday as the Fed minutes from the May meeting came out, indicating some participants favored tapering purchases of bonds if the economic data showed sufficient, strong, and sustained growth. Stocks moved down on that news, as did bonds, on concerns over higher rates. Interest rate sensitive stocks were especially weak. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, one part of the economy that Bernanke said is doing well, housing, and we got more proof of that today. Sales of existing homes rose in April to the highest level in 3.5 years. And the pace of sales would have been even higher if there were more homes on the market to meet that strong demand. But as Diana Olick tells us, that could change soon.
230,000 new listings came onto the housing market in April, a much-needed shot in the arm. But supplies are still well below where they should be, given all the new demand.
It looks and smells like a really fast-moving, crazy market, and we should maybe be thinking about how to put the stop on it. But the truth is, it looks to me like a simple supply and demand issue.
Nationally, listings in April were up 12% month to month, but still down 14% from a year ago. The picture is even more dramatic locally. For sale listings down over 20, 30, even 40% in some areas from a year ago.
I know the house is perfect.
With growing buyer demand, homes are now selling like it's 2005 again, the height of the housing boom. It took just 46 days on average in April to sell a house. That's down from 62 days in March and the normal average of 3 to 4 months.
I have sellers who are expecting to get multiple contracts the minute their house hits the market. Just today, I had a seller that I brought him a full price offer, and he chose not to take it because he wants multiple contracts.
The difference today is this is all about cheap credit, not easy credit. But mortgage rates have been rising lately, pushing loan applications down nearly 10% last week. Even the Fed chairman says lending is too tight.
I think over time, particularly as house prices go up a bit, that mortgage lending will become a little bit more accessible to a broader range of people, but right now it's still relatively tight.
And that's pushing much-needed first-time home buyers out of the market. They were at their lowest level in nearly 2 years. Apparently, cash is still king. On top of that, foreclosures are falling, which is of course a good thing, except that it's taking supply out of the low end of the market, just as demand is coming back. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up on the program, high-end home builder Toll Brothers has been one of the big beneficiaries of the housing recovery. And in a few minutes, you'll hear from the CEO about his outlook and his company's better-than-expected quarter.
And let's get more now on what Ben Bernanke said today and what it means for your financial decisions. Bruce Kasman joins us. He's the chief economist at JPMorgan. Bruce, thanks for coming on. You know, this is such a critical time, whether you're an investor, a borrower, or saver. Everybody's trying to gauge what's going to happen next for interest rates. Let's start with mortgage rates. Like the 30-year is now at 3.25%. Once the Fed starts withdrawing the stimulus, where are those rates going to go?
Well, I think they're going to go up. I think, though, we need to be clear that the rates will go up because the Fed is responding to a stronger economy. So what Ben Bernanke is telling us is that if the economy continues to strengthen, sometime later this year he could begin tapering purchases. Our forecast is that does happen in the fourth quarter, and that the 10-year yield goes up to 2.5%, and mortgage rates could go up somewhere close to 50 basis points.
So then does it make sense, if you're in the market to buy a home, this is the time to get moving and to buy something before the end of the year and lock in the lower rates?
Well, I think we should look at the long picture here. This is an economy which has plenty of room to run. It's improving. It should continue to improve. Certainly, rates will go up, but I think it's also the case that the labor market is going to improve. People's financial conditions will improve if this is a genuine recovery. So sure, it's a good time to buy and lock in rates now, but the picture should be one of sustained improvement, not of a Fed that's cutting off growth, one of a Fed that's responding to growth.
And what about for investors? You know, we've seen the stock market go from record to record. Again, once the Fed starts pulling back that stimulus, is that going to kill this market rally?
Well, there's going to be volatility. We've certainly seen it today. The market doesn't move in one direction. But again, I think a Fed that is responding to growth, normalizing its policy stance as the economy improves, is generally a good thing. It's only when the Fed needs to raise rates to slow down growth, to face inflation pressures, that we have a problem. And that's far out over the horizon, in our opinion.
Bruce, talk to us about savers. They've been complaining over the last couple of years with interest rates near 0%, really no place to put your money and get a good return on it. What's in for them?
Well, I think it's going to be a very modest rate increase here as the Fed does not begin raising interest rates for a long time. So we're still in a very low rate environment. I think the prospects are that there is going to be a better economy, and over time we'll see returns on his savings go up. But right now it's a world where equity markets, where riskier investments are being favored. It's the way to get the economy going. Interest rates are going to stay low here, and perhaps not quite as low as they've been in the last year.
And then the other big question is, how long will Ben Bernanke be calling the shots? The last question that he got today during the hearing was that if he were offered another term, would you accept? And he says, I'm not prepared to answer that right now. Is there any reason for investors and savers to be concerned of somebody else running the Fed over the next couple of years?
I think we most likely will see a new Fed chairman at the end of Chairman Bernanke's term. I think it's quite reasonable to expect continuity, however. I think the appointments that President Obama have made have been very solid ones, and I would expect the same to happen when Chairman Bernanke leaves. He's done an excellent job, but someone else can continue his work.
All right. Thanks a lot, Bruce. Bruce Kasman, Chief Economist at JPMorgan.
Ben Bernanke's Senate testimony wasn't the only closely watched session on Capitol Hill today. The IRS official at the center of the controversy over the targeting of conservative political groups says she did nothing wrong and broke no laws. At a House hearing investigating the extra scrutiny the agency visited on conservative groups seeking tax-exempt status, Lois Lerner thought she invoked her constitutional right to avoid self-incrimination. But one outraged congressman objected, saying she effectively waived her Fifth Amendment privilege. Here's what happened.
I will not answer any questions or testify about the subject matter of this committee's meeting.
We will take your refusal as a refusal to testify. The witness and counsel are dismissed.
Mr. Issa, Mr. Cummings just said we should run this like a courtroom, and I agree with him. She just testified. She just waived her Fifth Amendment right to privilege. You don't get to tell your side of the story and then not be subjected to cross-examination. That's not the way it works. She waived her right to Fifth Amendment privilege by issuing an opening statement. She ought to stand here and answer our questions.
Now, today's hearing was put in recess, not adjourned, and that leaves the door open for Lerner to be called back to testify at a later date.
Also in Washington, a far-reaching bill to overhaul the nation's immigration system is now headed to the full Senate in early June. The Senate Judiciary Committee easily passed the measure late Tuesday, paving the way for 11 million illegal immigrants to receive permanent U.S. citizenship. Passage in the Senate and the House may be more likely after a Democrat-led amendment extending immigration rights to same-sex married couples was pulled.
Earnings after the bell tonight from Hewlett-Packard. Bottom line results better than analysts expected, but sales of personal computers continue to tank. Jackie DeAngelis joins us now with more on the last quarter's numbers and what's ahead for the biggest PC maker of them all.
And that's the question. Tyler, Susie, good evening to you. You know, Hewlett-Packard made 87 cents a share last quarter. That was 6 cents more than Wall Street was expecting. But the company's revenues, they fell to just under $28 billion. But remember, this is a company in the midst of a turnaround. Meg Whitman, HPQ's CEO, has said that it could take years for that turnaround to take place. Now, Wall Street seemed happy with the report. The stock was up higher than 10% after the announcement, but the company has some challenges ahead. HP's flagship personal computer line is down 20% as consumers continue to switch to their tablet computers. Now, on the brighter side, the company saw strength in its printing segment and also in its enterprise services business.
All right, the road ahead, uncertain for HP. Jackie,
absolutely.
Thank you very much. And still ahead, just how hot is the housing recovery? The CEO of Toll Brothers, one of the biggest players in the industry, ranks the market on a scale of 1 to 10. First, though, some stocks that hit all-time highs today. We begin Market Focus tonight with a mixed bag of retailer earnings. After the close, L Brands, which operates Victoria's Secret and Bath & Body Works, reported a 14% jump in profits, improved revenue there, and they raised their guidance as well. Shares of L Brands had been down about 0.5%, closing at $51.47, and then it jumped after the close.
Shares of Staples rose sharply despite a lousy earnings report. Profits were down more than 9%, but the company's CEO told analysts he's confident in the earnings outlook for the year and expects cost-cutting and online growth to boost sales. Investors bought into that view. Staples shares jumped almost 3% to $15.17. Quarterly earnings at Target plunged almost 30%, and the retailer lowered its earnings guidance for the year. Target blamed cooler weather and the payroll tax for soft sales and dismal profits. Shares tumbled 4%, closing at $68.40.
At the top of the S&P 500 gainers today, Bristol Myers on the strength of a city upgrade, calling attention to the company's cancer immunotherapy potential. Bristol's new treatment, now in phase 3 testing, could win approval earlier than anticipated. This according to that city report. Bristol Myers up more than 5% at $46.40 a share.
And General Electric gained today on comments by CEO Jeff Immelt that an IPO spinoff of parts of GE's financial business is a, quote, possibility. Immelt also reiterated full-year growth targets for the company. Investors pushed GE shares to a new 52-week high before the stock fell back a bit to close at $23.86, up almost 1%.
A stronger housing market helped luxury home builder Toll Brothers post quarterly profits today, 40% higher than a year ago. The company cleared nearly $25 million in earnings on sales of $516 million, and those sales up 38% from last year. Earlier today, I spoke to Toll Brothers CEO Douglas Yearley, and I began by asking him how he'd rate the housing market right now on a scale of 1 to 10, with 10 being very hot.
Oh, I think I'd give it about an 8. We've certainly had better times, but boy, this is, and remember that 8 is relative because we've been through 6 really bad years. So there's no great inflation right now for me. I think it feels really good based on where we've been. We obviously have room to go. I think it's relatively early stage of recovery, but we're raising prices again. We're seeing some big demand come back out. As we raise price, it seems like there's more demand as people feel the urgency to get in before prices go higher. So I think a solid 8.
So since you raised the question of prices, how are your prices tracking, and what are the average selling prices, and are you having some pricing power here?
We are. We just announced today that we raised price $26,000 on average per home, and our houses sell for about $600,000, and that was for the 3 months from February through April. So when you annualize that, it's a pretty big number. We're raising prices in about 60% of our communities. We have about 225 communities open for sale in 50 markets around the country. Those 60% of the communities that see price increases account for about 70% of the sales, because where we raise price tend to be the hotter communities. It's very community specific. So, Northern California, virtually everything sees a price increase. Southern Cal, virtually everything sees a price increase. But there's many markets where, some communities are seeing price increases and others are not. But overall, we're thrilled to be in that position now. Buyers are coming back out after being on the sidelines for 6 years to take advantage of these interest rates, and business is very good.
So you mentioned a couple of markets that I assume are among the hottest. What are the hottest markets right now, and which ones remain comparatively dormant?
The hottest markets are New York City urban for us. We call it our City Living brand. We build in Manhattan, Brooklyn, and Hoboken, and that market is absolutely on fire. We have new buildings that opened 3-4 months ago where pricing is up, $150,000, $250,000. Right behind New York would be Northern California. Both the South Bay and the East Bay are very hot. Significant pricing power there. Coastal Southern California, principally Orange County, is very strong. Softer markets, the Midwest is still a little bit soft. It's a little bit slower to recover, although there is strength in Michigan, of all places. And that's really about it in terms of the soft markets. If you asked me that question 6 months ago, I'd have a handful that I'd say are soft, but right now that list is dwindling.
Well, that's good if you're a home builder. How does the rest of the year look, and do you worry at all on this day where the 10-year bond closed above 2%, what rising interest rates might bring?
If the rates go up slowly, which they may, we're fine. It's going to create more urgency as people want to get in. Obviously, if the rates were to skyrocket up, go up a couple of points, that would be a different issue. But I don't think anybody thinks that's going to happen. So, you know, I think we're fine. If the rates went to 4, 4.25, 4.5, you know, even the high 4s, but that happened progressively over time, I don't think there's any problem at all. That's still a historically low rate when you consider where they've been in many good times in the past.
Shares of Toll Brothers rose to a 7-year high today before pulling back. The stock is up about 38% over the past year, bettering both the Dow and the S&P.
And coming up on the program, there's a powerful new tool now in the hands of doctors. And it's not only helping physicians improve care for patients, it's also helping to bring down costs. But first, let's get a check on how some of the most widely held stocks closed out the day.
Real-time data technology has opened a new frontier in the care and cost of treating patients by better managing their treatments and helping avoid costly hospital stays. Bertha Coombs has the latest in our series on the future of healthcare with a look at how real-time data could be a real-world game changer.
Hannah, get up. I've got 2 kids. They're always scared every time I go to the hospital.
Rachel Malott has been in and out of hospitals for years.
I kept asking them, you know, can you find out what's wrong with me?
Suffering from osteoarthritis, high blood sugar, and liver disease, no one seemed to be able to help her get a handle on it all.
I thought, you know, there's no doctors that care about patients anymore.
6 months ago, that changed.
Hey, Rachel.
At Cincinnati's Mercy Health.
And I know I'm not just another number in their office. They actually do care about me.
They do. Mercy Health is a designated accountable care organization, or ACO. Under the Obama Health Reform Act, Medicare now pays ACOs higher rates for improving patients' health and avoiding costly hospital stays.
To be able to reach out and care for patients in a timely manner, in real time, prompted us to realize we were going to be able to need data more quickly.
Using a big data program from privately held Exploris, Mercy's been reaching out to its high-risk patients.
I see that we are almost up to the 30-pound mark since November, that we've lost weight.
More actively working with them on preventive care.
Everyone thinks that they're doing a great job, but there is a great deal of variability when we look in the data.
That variability, by some estimates, costs the nation's health system hundreds of billions. Rachel is one of 9 million disabled and older Americans eligible for both Medicaid and Medicare. The sickest 20% of these patients account for 2/3 of health spending in those plans. Big data can help sort out unnecessary care, but it requires a big shift.
It's not just technology that's going to solve the problem, but it's going to be change management, meaning that who should we have involved? What kinds of care coordinators should we have involved?
A McKinsey study predicts the shift in reimbursement models and the push towards greater evidence-based medical care will drive strong demand for big data in healthcare over the next 5 years. The big challenge will be finding enough skilled workers to use it.
And to really make a difference.
My mom and my family's like, you know, you're more like yourself now. You're back to our Rachel.
Bertha Coombs, Nightly Business Report.
And tomorrow we continue our series with a look at the growing demand for a new type of healthcare worker, the data scientist.
Forbes magazine is out with its annual list of the world's 100 most powerful women, and most of them are political leaders. German Chancellor Angela Merkel tops the list, followed by President Dilma Rousseff of Brazil. Third is Melinda Gates, the wife of Microsoft founder Bill Gates and the co-chair of their philanthropic foundation. Other top business figures on the list include Facebook's Chief Operating Officer Sheryl Sandberg at number 6, followed by Christine Lagarde of the International Monetary Fund and PepsiCo's CEO Indra Nooyi at number 10. Now, the youngest on the list was the singer Lady Gaga, just 27 years old and coming in at number 45.
Well, powerful people take home powerful paychecks, and it may be no surprise that American CEOs took home more money last year, with the median pay up more than 6% to an average of nearly $10 million a year. That's an all-time high. And even though a new Associated Press report on executive pay says there were fewer female CEOs at the nation's largest publicly held companies last year, those women, on average, made more than their male counterparts, over $11 million a year, Tyler.
And you're smiling.
Yes, I wish I were one of them. I need a couple more zeros.
One of them. No, it's nice to see more pay parity, for one thing, for sure, even though the number of female CEOs seems to have ticked down just a little bit.
Yeah, it's also nice to see that these women are not just in fashion,
no.
But they are in technology, they're entrepreneurs, and they're heads of state.
Yeah, that's right. Think of Meg Whitman out at Hewlett Packard.
Absolutely, lots of them.
Excuse me, not Meg Whitman. No, it is Meg Whitman.
It is Meg Whitman. You were right the first time. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for joining us.
And I'm Tyler Mathisen. Have a great evening, everybody. We hope to see you right back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. Conflicting words from the Federal Reserve and its chairman Ben Bernanke about how soon to begin tapering back on its stimulus plans sent the markets on a wild ride today. After being 154 points higher early in the session, the Dow ended 80 points lower. The Nasdaq down 38, the S&P fell 14 points. Good news in housing. Sales of existing homes last month rose to a 3.5-year high, and prices were up 11% from last April of last year. Shares of Saks Fifth Avenue rose 13% on reports that it might be putting itself up for sale. And a new survey shows CEO pay rose to nearly $10 million last year. There were fewer women CEOs, but they made more money on average than men. Be sure to tune into Nightly Business Report right here on your public television station.